Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I want to continue with the if I can do it, so can you, with two mystery charts this week. I want to talk about 17 secrets to trading, and it might take us more than one show to get through them all. Depends on how many anecdotes I get into once I start talking. And housekeeping. By the way, I do take requests. So if there's something you want me to cover, let me know. As I say each week, if it doesn't fit into this venue, I do a show on Thursdays at 6 p.m. Central Time, 7 o'clock Eastern at night. And that is, I guess PM is night. And those shows are a little bit more freeform, where I could take a little bit more time and work on different things. So if there's something you want covered, please let me know. You can reach me at davelandry.com/contact with those requests. If you want the slides of this presentation and all the other presentations, go to davelandry.com/StockCharts. I'll also give you a bunch of other stuff to keep you busy for a long time, including all three of my books. So let's talk about this week's mystery chart. This is an IPO. It's had a really nice uptrend to it, and it's pulled back, and I think it's poised to resume its uptrend. We have an entry here, we have a stop down here, and an initial profit target up here. By the way, if you want to see a lot of these previous mystery charts, I think 100% of them so far have come directly from my trading service. And if not, the other ones may have come from the Facebook group. For the most part, I think most all have come from the trading service. Go to davelandry.com/archives, and you can see those archives. So that way you know there's no hindsight in any of this stuff. Our next mystery chart has been in a very nice longer-term uptrend. I guess has been being a key word in that sentence, or key words. As you can see, it makes an all-time high here. Notice that evidenced by the bow tie moving average proper order on the bottom, and this is in the plugin of mine. The plugin is free, absolutely free. All you have to do is like this video. And you can see that it turns from uptrend proper order to downtrend proper order, meaning the 10 simple greater than the 20 exponential, greater than 30 exponential, to the 10 below the 20 exponential, and the 20 exponential below the 30 exponential, so quickly that they don't actually take any time to meander back and forth. For instance, notice if we go back to earlier this year, you can see longer term uptrend, and then they began to kind of zigzag all around before the uptrend resumed. This time, they came together very tightly and spread out again, given the appearance of the bow tie, hence the name. So this is a short entry here, stop up here, initial profit target down here. This is not triggered as of about an hour before the close on March 18th. Now, what I want to talk about now is classic Dave Landry. For those of you who know me, there's a lot of things, and a lot of stories and anecdotes that I'm going to repeat. And sometimes it bears repeating, and sometimes I need to hear the same things too. So when I was looking for ideas for this presentation, I went back a couple of years and I found a presentation. I think it was probably originally done in 2017. I did it again in 2019. And since it's been a couple of years, I thought it'd be a good time to brush up on these 17 secrets to trading. So be warned, there is going to be a little dead horse beating. If you know me, I tend to say the same things over and over. The good thing is I am consistent. A while back, I was guest of honor at Charlie Kirk's retreat down in St. Lucia a few years ago. And one of the guys that was down there did a little due diligence before he hopped on the plane. And he said, you know, Dave, I did a little research on you, and I noticed that 20-something years ago in a forum, you were saying the same thing that you're saying now. And he was referring specifically to bow ties. So even though I do kind of say the same stuff over and over, at least I think I am consistent. In trading, I think it's very important to remain consistent. One of the things that the same gentleman actually pointed out was there's a guy out there, not to throw anybody under the bus, but he's always telling you about this great thing, and if you give him a bunch of money, he's going to sell you this great thing. Well, last month, he was also selling a great thing. So this new great thing, is it greater than the last great thing? as opposed to remaining consistent. Now, before I digress too far, let's talk about 17 secrets to trading. The first secret to trading is there is no secret to trading. Now, all these gurus out there will lead you to believe that if you just give them a bunch of your money, they're going to give you the secret formula. Well, believe me, if they had the secret formula, they could make a lot more money keeping it to themselves. But Dave, you might be thinking, aren't you selling stuff? Well, I'm selling common sense. I'm selling a conceptually correct methodology. I'm selling a lot of hard work in my analysis that I provide every day. And I probably go maybe to an extreme, maybe to a fault, in telling you that you can lose money trading and you're not going to print money trading, but longer term you should do just fine. By the way, I don't want to be Schadenfreude, but these jerks, I think, kind of deserve it. There's a firm out there just got sued for 130 something million or 112 million, I forget, a million here, a million there, 100 million here, 100 million there, and it looks like they're going to be out of business, which is good because they were busy fleecing clients. But I digress. Now, the thing to ask about these gurus is repeatability. Now, some of these people do have some claims to fame. I know one guy, and he's not selling anything, believe me, and he made, I think it was like 80 million in the options market. And I asked him when I met him in person once about that. He says, yeah, Dave, but there's no way I could do it again. We were like in the land of the blind and had one eye because they had a model that worked within the system, but it no longer works. So the question is, could they do it again? I had a friend, as I often say, he turned about $5,000, which I later learned was of questionable origin, into roughly $1 million. And don't quote me on this because I know I say the numbers a little different each time, but I want to say, I believe I saw a statement that was at 975K. So close enough to $1 million. I'm sure intraday was well over $1 million. Now, he ended up homeless and ended up on my couch for a while. Luckily, my wife came along and got rid of him. He's no longer with us, so we could talk about it, but that's another story altogether. So the question is, can you rinse and repeat? Yeah, you could turn a small sum into a lot, but it might just be a fluke and it's not repeatable. Repeatability is a very important question. I'm going to show you some simple things. I'll show you a few simple things today. And I truly believe you can go out and do these things, provided, of course, you get a little bit of experience and you understand a little money management, and, of course, some trading psychology to boot. So, can you rinse and repeat? That's the question. The other question is, can they rinse and repeat? And the answer is probably not, okay? Maybe they did get lucky. Maybe they're in the right place at the right time, and they turned some gifted money into a large sum. But could they do it again? Probably not. Or, I don't know if you guys remember this. These slides are a little low, but David was one of those wisdom teeth removal videos. So seriously, don't beat yourself up. No one knows exactly what a market will do. Not you, not me, and certainly not the guy who screams on TV. Again, I tell you, classic Dave Landry. How many times have you heard me say that? Number 2, you don't have to be a brainiac. Average intelligence is adequate. I was once called a trend-following moron by somebody I deeply respect. It makes me realize the saying, never meet your heroes, right? Turns out the guy was a jerk. He called me a trend-following moron and some other really nasty things that we don't have time to get into now. Maybe if you buy me a beer someday, or I'll buy you a beer, we can discuss some of these things. And I was really upset about that for quite a while. But then I realized, when I just blindly follow along like a good little moron with the market's trend, I tend to do really well. When I try to fight the trend or outsmart the market, I don't do so well. I think William Eckert said it the best. I haven't seen much correlation between good trading and intelligence. Many outstanding intelligent people are horrible traders. Average intelligence is enough. Beyond that, emotional makeup is more important. And that's why I spend so much time talking about trading psychology, and I'm going to get into that in just a few minutes. So I do believe that attitude is much more important than aptitude. Give me somebody with a good attitude that's willing to accept what is. Markets go up, markets go down, markets go sideways, a little spoiler alert, as opposed to some brainiac. So here we go. Number 4, secret to trading. Markets go up, markets go down, and sometimes they just go sideways. Now, a big duh implied, I know I'm being a little facetious, as Captain Obvious rears his ugly head, but you'd be surprised at the number of people who fight the market. Right now, things are getting a little iffy. We could be rolling over, could be the key word in that sentence, and I guarantee you there's going to be a lot of people who should know better, probably smart people, who are going to fight the market instead of following it lower by shorting or at the least getting out of the way. Now, every now and then, I'm a little guilty of trying to outsmart the market. So on the back of my business cards, I put a little trend follower. This is my actual business card. Uptrend, downtrend, and sideways, or no trend. By the way, the bull is not humping the bear and smiling about it. I noticed that after I got the cards printed up. Or actually, somebody else noticed it during one of my presentations, one of my live presentations. Now, like I said, sometimes I don't listen to my own stuff, fight the trends, or try to outsmart the market. So I have a little reminder on my right arm, just in case I lose my way. Number 5, news is noise. Ignore all news. Read my lips. Now, it's funny, just as soon as I say this, or 5 minutes later, somebody's going to say, what about this? What about that? And the answer is, no, I ignore all news. I was speaking in New York a few years back. Well, I guess it's been more than a few years now, maybe a decade ago. Anyway, I was talking about how bearish I was on energies, and I showed some shorts I was just about to set up. I showed some stocks that I was short in energies. And as I'm going through the presentation, somebody blurted out, which can be best described in a Henry Kissinger voice, what about the situation in Nigeria? And I'm like, what about the situation in Nigeria? I had no idea there was a situation in Nigeria. Apparently, there was a situation in Nigeria that could drive oil prices up. That was the news of the day. Well, guess what oil prices did? They went down, and all of these stocks went down. Your life's going to get a lot easier when you stop watching the news. And I would encourage you, and I have to admit, I take a little peek every now and then. I do get a little through osmosis as far as like the world news. But I would encourage you to watch as little of the world news as possible, and especially avoid all trading-related news. And your life's going to get a heck of a lot easier. Now, I do believe that technical analysis leads the way. What is. And as I often preach, if a market's going to go from A to C, it's going to have to pass through B along the way. Other than an IPO strategy, which I actually call buy at B, you can't just buy at B, but you'd be much better off than trying to fight a trend. And the other strategy I have, which we talked about last week with the market timing, is the 10% TFM system, where we're looking to stay long as we are near C. Because if a market's going to go beyond C, not to be confused with Beyonce, it's going to have to pass through C along the way. If the market's going back down to B or back down to A, God forbid, it's going to move away from C, pass through B, on its way back down to A. So I have some simple systems that just look at something as simple as looking to get long, something like an IPO, right around that B area, and looking to stay long the overall market as long as it is near C. I had a fetish a while back where I bought every domain I could think of, and one of my favorite statements is, don't confuse the issue with facts. The thing to realize about the stock market, and every time at a cocktail party or a wedding or whatever, and somebody starts asking about stocks, I try to explain to them it's just kind of a supply and demand thing. And usually I'll take off my jacket and show them my arm and try to explain it based on it going up, going down, going sideways, like we just talked about. The bottom line is, if people, quoting Tom McClellan's mother, Marion McClellan, some people buy when they have money, some people sell when they need money. And the beginning of that quote is, everyone uses timing in their investments. So the overall market is based on whether or not people are buying stocks or selling stocks. Is there supply or is there demand? So the bottom line is, and I found this slide by accident from another presentation, and you should read this book, The Psychology of Stock Market. It's in public domain. I've read it online before, and I think I probably have about 3 copies here. Whenever I can't find a copy, I just buy another one. But it's a wonderful little book. It's called The Psychology of Stock Market by G.C. Selden, probably written about 130 years ago, or at least 100 years ago. And the bottom line is this: for we all realize that the prices of stocks must, in the long run, be controlled by the public opinion. The point we fail to remember is that the public opinion is speculative market, is measured in dollars, not in population. So people are voting with their dollars, and that creates supply or demand for a stock. And remember, people buy and sell for a variety of reasons. Quoting Tom McClellan's mother, late mother, Marion McClellan, some people buy when they have money and some people sell when they need money. Now keep in mind that every methodology has its nuances. There is no perfect methodology out there. I think I would have found it after around 30 years of hunting for it. And I'm a member of the American Association of Professional Technical Analysts. I guess I've been a member for, 10 years. I'm not sure how long. It's been a while, maybe even longer. And if I didn't find it, I'm sure somebody in the organization would have found it by now. With my methodology, there'll be times where you absolutely print money. And if somebody comes into, let's say, my trading service and we're printing money, I really have to temper their expectations. I've seen people do stupid things trading my methodology, like tell the boss to get lost, to put it mildly, quit profitable businesses, etc. And again, like I said earlier, I'd probably do a lot better if I didn't spend so much time trying to temper everybody's expectations. Momentum trading can be streaky. I gave a speech many years ago. Peter Mothy, who I'll mention here in just one second, was the host, and he invited me. And after the speech, he gave me a little constructive criticism, and he said, "Hey, use the word streaky in your speech. That makes it sound too elusive." And I said, well, it is a little streaky at times, and sometimes you have to catch that occasional outlier to really do well. We have one in a portfolio right now. It was up, at least last week, about 500%. And that makes a big difference in your returns. There's going to be choppy times when you are kind of stressed out, or sharp market reversals, and you're going to be on the other side of the market as a trend follower, and that's going to really stress you out. And if you get stopped out of your positions because the market becomes choppy, you might have to sit and wait and wait and wait for the next trades. So these are all nuances of the methodology. Believe me, there's plenty more. Speaking of Peter Mothy, a few years back, he invited me to be part of a project. And the way you got paid on the project was to recommend a trade. And you got paid so much based on each recommendation, based on how many newsletters they sold. Now, newsletter was a $40,000 a year institutional project. And I told Peter, I said, "Peter, I might not be your guy, because if conditions aren't conducive, I may go days, weeks, and even months without coming up with a trade." And he said, "You're exactly the guy we want. Don't invent trades." And that really struck a chord with me. And by the way, I didn't invent trades, and I waited and waited and waited. And I guess other people in the project thought this guy never does anything. And then when I started seeing all the stars align and everything looking pretty good and some nice trends developing, I began to submit trades. And luckily, those trades did really, really well. And I say luckily, and I think if I always was that patient instead of recreational trading on occasion, which I'm occasionally guilty of, okay, I'm not perfect, then I probably would do pretty darn good. So as I preach, if you're looking for excitement, go to Las Vegas or have an affair, because that way you only lose half of your money. Number 8, you need just one and only one simple methodology. So you got to be careful chasing the Holy Grail. We've all been there and done that. Many years ago, I would wake up really early. I still wake up early. Every time I see that commercial for, I think it's Geico or Progressive, we can't stop you from becoming your parents. You woke up early. No one cares. But I would wake up super early. I still wake up super early. Get up at 4:55 every day and start doing my analysis and looking at markets and other stuff. And I would wake up early and work on trading systems, program, mechanical systems, and research. And I still do some of that, but a lot less mechanical stuff. And every day I'd come home and tell my wife about the latest trading system, and I'd spout off some statistics, and she would suffer a fool gladly. And then one day she said, how many trading systems do you really need? You guys who are married, you probably know your wife can ask these questions that are kind of tough, but make a lot of sense. And it took me a little while. I was a little taken back because I was all excited about the system du jour. And then it dawned on me, you need the one that you're going to follow. So it was an epiphany for me. You need just one trading system. And that's the one that's conceptually correct. That means that there's some sort of concept behind it that makes sense. So in other words, I think pullbacks makes a lot of sense. You're looking for a market to be trending. You're looking for some people to get knocked out of that market, okay? And then when the trend resumes, you're looking for those people who likely want to get back in, or if the shorts shorted it, because the shorts think they're smarter than the rest of us. And I short stocks too, but believe me, I know. Shorts in general tend to fight trends because they confuse the issue with facts. But anyway, if they get knocked out, and I have a pattern I call the trend knockout, and if you watch prior shows, you'll see that, they'll be forced to buy back in as that price goes higher. So that would be an example of something that's conceptually correct. It also has to make sense to you, and above all, the one that you can follow consistently. And what I tell people all the time who are trying to trade 50 different systems is if you can't trade one system, what makes you think you could trade a dozen? So do one thing, do it well. My work is done. Peace out. Dropping the mic as I walk up the stage. I've actually broken a couple of mics. Doing my little mic drop. I'm going to have to maybe get one of those broken mics out and I could drop that. I think Landry said it the best. All you need is one pattern to be successful. And of course, the famous Bruce Lee quote, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. Now, what's the one pattern? Well, that's up to you to decide, but I think something simple like Landry-like pullbacks can work. Here's the Bitcoin example that I've shown quite a bit recently. You wait for a pullback to the moving average, and then you look to get long as that trend resumes. And if you look at the bottom of the chart, this is the ACP plugin, by the way. You can see nice Landry light followed by a little dive down to 0. This counts the number of days the bars are above, the lows are above, I should say, the moving average. And if it's red, the highs are below the moving average. So 10 bars or so if the market is accelerating higher, or 20 bars or more if it's in more of a gradual trend. And then again, just look for a pullback to the moving average. But Dave, you keep showing that Bitcoin example. What have you done for me lately? Well, let me show you a live example. And this is Ethereum. I actually have orders in right now to buy this. And you can see back here, it's a decent example. We had a nice little Landry light, little pullback to the moving average. The trend begins to resume, and we get long. And I do think that I got long back there, if memory serves. I can double check for next week. And then once again, we've got nice Landry light as evidenced by the lows greater than the moving average, or you could look at the little indicator on the bottom. And then a pullback to the moving average, which resets the Landry light. So I think a plausible entry would be about 37.50 on Ethereum. Number 9, you must plan the trade and trade the plan. Plan thy trade, trade thy plan. For a long time, I wondered why people didn't bother using stops on their trades. And it dawned on me. We used to live out in the country, and it was about 2 miles around the block, a big block, right? And about halfway through a walk one day, I realized that the moment you plan your trade and have a stop as part of that plan is the moment that you realize you could be wrong in a trade. We don't like to be wrong. In fact, I took a personality test based on Larry Williams' son wrote a book on trading psychology. It's a really good book. And I always forget the name of it, but I'll get that for you in post. And anyway, he recommended you take a personality test. And I took my personality test, and I scored about a 0, if that high, in agreeableness. And I told my kids and wife that, and they looked at me like I pooed my pants. Kind of that same look you get if you walk into Starbucks and ask for a cup of coffee. Something I did many, many years ago. Because back then, I lived in the country and I didn't get to Starbucks much. Anyway, they couldn't believe that it was a big old epiphany for me that I was not agreeable. And I thought I was a very agreeable person. The other sin I see quite a bit when it comes to not planning to trade and trading the plan, especially not trading the plan, is micromanaging. Now, it's hard not to micromanage because we're wired to avoid pain. And there's not enough time to get into it today, but there's a big neurology that we'll get into a little bit next week. We'll scratch the surface a little bit next week, but there's a big neurology to all this that stops us from following the plan because we want to avoid the pain. So here's a trade where we got in, and if it's green, it means we're making new equity highs. If it's red, we're giving up profits or losing on the trade. So green, red, you can see kind of rinse and repeat. So let me show you the entire trade based on what was profitable, days that were profitable, and days that were giving up open profits or not profitable. And you could see as this trade develops, there's more and more and more red, and a lot of red over the last month or two in here. Now, you look at this with all this red and very little green, you might be thinking, well, this is a losing trade. Well, quite the opposite. We were up about 500%. I know I'm beating a dead horse lately on this one trade, but this is what we live for as swing to intermediate term traders. We're looking to get a swing trade off, and then we're looking to stay with that position as long as it moves in our favor. But as you can see, this market backed and filled quite a bit, and you spend weeks, and in some cases months, where you've given up open profit. There's another one in our portfolio right now that's going sideways for months and months and months. It's a metal stock, and I'd be willing to bet that most people have already exited by now and given up, but just recently it began to rally, and now the metals are doing extremely well. And let's not start kissing each other just yet, but I'd be willing to bet that that position will turn into a really nice winner. Well, that's all my time for this week. When we continue next week, I'm going to pick up where I left off and finish up these secrets to trading. In the meantime, if you need some more information, davelandry.com/StockCharts. Again, I'll give you all 3 of my books for free. Get to know me first before you put down any of your hard-earned money. And if you need to reach me for anything else, davelandry.com/contact. I want to thank everybody for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.